In 1922 in Germany, a loaf of bread would have cost you 160 marks. By the end of the following year, that same loaf of bread would cost 200 billion marks. Hyperinflation in post-World War I Germany came about as a result of massive government borrowing, but also some other factors, including them printing a huge amount of currency. The government was printing huge amounts of banknotes without the economic resources to back it up, as well as using them to purchase significant amounts of foreign currency. They were also paying industrial workers huge quantities of banknotes to pay them for their labour. All of this contributed to a period of hyperinflation. On the shelf behind me, I keep a $10 trillion banknote from Zimbabwe, and it's there as a reminder of the perils of hyperinflation. Now, while hyperinflation is exceptionally rare in developed economies, there are numerous examples of it having happened throughout history. Could we be headed for a period of hyperinflation here in the UK in 2021? After all, we've borrowed significant amounts of money, and we have printed stacks and stacks of banknotes as well, all in the fight against the global financial crisis initially, and then more recently in the fight back against coronavirus. By the end of this video, I'll explain why hyperinflation is a threat for the UK economy in 2021, and also the steps you can take to guard your wealth against the risks of inflation. Hi everyone, I'm Martin Bamford, a chartered financial planner at Informed Choice, and on this channel I make videos about personal finance, investing and happiness. If you'd like to watch videos that will make you wealthier and make you happier, if that sounds like a great result, then please do click that little red subscribe button so you don't miss out on any future videos. It would be fantastic to have you join us in our subscriber community here on YouTube. So my $10 trillion note from Zimbabwe on the shelf behind me, I keep it there as a reminder of the risks of hyperinflation. That story started around February 2007. Shortly after that, I was staying on a farm in South Africa just across the border from Zimbabwe, and hearing about some of the stories happening just a few hundred miles north in the country. And it developed very quickly. By the following year, hyperinflation had set in and had become a really dangerous phenomenon. It was quite difficult to measure accurately in 2008 and 2009 because the Zimbabwean government stopped publishing official inflation figures, but there are some estimates of how bad things got. It's estimated that hyperinflation peaked in Zimbabwe at 79.6 billion% month on month, and at 89.7 sextillion% year on year in November 2008. You might be thinking right now, what on earth is a sextillion? It's not a number, thankfully, we come across in everyday use. Well, it's a 1 followed by 21 zeros, or in other words, a billion trillions. It's a mind-bendingly huge number. In fact, I have to be a little bit careful when I refer to such massive numbers, because going back to the 1920s in Germany, in the Weimar Republic, when hyperinflation was rampant, doctors there identified a mental disorder called zero stroke or cipher stroke, and this was characterized by patients writing endless rows of zeros known as ciphers. Zero stroke was supposedly caused by the maddening impact of having to calculate these huge numbers to buy and sell things, and it was just too much for many brains to comprehend because prices were rising so quickly for everyday commerce. During the worst periods of hyperinflation in 1920s Germany, the price of a cup of coffee would double in the time it took to drink it, and workers were asking to be paid at the start of the day so they could actually afford to buy the things they needed, because the prices would have gone up so much by the end of the working day. It was an absolutely crazy time for the economy there. But of course, here in the UK, things are not going to get as bad as 1920s Germany or 2008 Zimbabwe, are they? We're in a completely different place. But are we? Let's look at some of the factors which could contribute to inflation or even hyperinflation in the near future. In recent years, I think it's fair to say that we've taken low inflation for granted. In fact, many economists will now tell you that inflation is dead. It's not ever going to return. But look at what central banks have been doing, both here in the UK and also in other developed economies. They are printing stacks of money. It's a process known as quantitative easing, or QE. They're using that money to buy up government debt, also to buy up corporate debt in some cases, and that pushes the yield, the cost of borrowing, right down, because there is an inverse relationship between the price of a bond, which goes up, and the yield from a bond, which then goes down. And then public debt in developed economies has risen sharply 2022, it now stands at approximately 125% of gross domestic product, GDP. That's a number that would simply be unthinkable as recently as, say, a decade ago. But governments in developed economies around the world have borrowed huge sums of money. At the same time, economists and commentators who warned of rising price inflation following the global financial crisis, following that first round of quantitative easing, have been left with egg on their face because that price inflation failed to materialise. So I know many are wary now of predicting more price inflation in the future because they got their predictions wrong the first time. But sticking with the picture close to home here in the UK, what are the chances of inflation rising sharply in 2021? And of course, we're starting from a very low base. The latest official price inflation figures for the year to October 2020 show the Consumer Prices Index, a CPI measure of price inflation, that's the official government measure, at 0.7% for the year. That's up from 0.5% for a year to the month earlier. So inflation's still very low. The government, the Bank of England's inflation target for CPI is 2%, so at 0.7%, well below that inflation target. There are, however, several factors which combined together should warn us about a potential for much higher price inflation in the near term. Now, one is what's happened during this COVID-19 pandemic. Through the lockdown, through banks lending lots of money, often with a government-backed guarantee. And in the main, consumers have been sat at home, twiddling their thumbs, unable to go out and spend money. So if you're still in employment, as many people during the pandemic have been, and you're still earning what you were before, but you're not able to go to your favourite restaurant, you're not able to hop on a jet and go off on holiday, you are saving and accumulating all that money. Now, what happens now we have the vaccine, now that vaccine rollout programme has started, what happens when the economy reopens? When the shops and the holidays and the restaurants are all open to us again as consumers, there is a genuine fear, and I think it's a correctly held fear, that consumers will go out and have a bit of a splurge with all this accumulated cash. And economic theory tells us that when there is increased demand but static supply, as would be the case if consumers go out and start shopping like crazy, then prices rise as a result. So that's one factor we have to watch out for. Something else to add into this potent inflation mix is this Brexit situation. So as I record this on Sunday afternoon, we do not have a Brexit trade deal still. That means on the 1st of January, reversing to World Trade Organization rules, what Boris Johnson has incorrectly been calling an Australia-style deal, and it means higher tariffs on goods and services between us and the EU, and a very high probability that prices will rise for imports to the UK, at least in the short term. So that could well fuel rising price inflation too. And then also, behind the scenes, the Bank of England is continuing with its bond buying programme of quantitative easing. It has now printed £875 billion worth of money in order to buy up corporate bonds. It's bought already a further £20 billion in corporate debt, non-financial corporate debt instruments. And that bond buying programme is scheduled to continue until the end of 2021. Now, of course, the Bank of England could take its foot off the gas. If it starts to see some signs of economic recovery in the early part of 2021, if it starts to see inflation rising and rising sharply, it can slow down that bond buying programme or stop it entirely. It could even, in a worst case scenario, start to hike interest rates. Now, it will have to balance this issue of price inflation with economic recovery, and with such an uncertain economic outlook in the short term, that's something they're going to have to be very careful about. To rise interest rates could choke off economic recovery very quickly. But if the Bank of England gets it wrong, that could fuel inflation, that could lead to a hyperinflation scenario. Keep in mind that they haven't got it wrong yet. This quantitative easing programme has been in place since after the global financial crisis, and what it has succeeded in doing, both here in the UK, but also in the EU and in the United States, where they're also printing money from their central banks, it has prevented us from falling into a deep economic depression. It has maintained the status quo of the economy to some extent. So to date, whilst they may have been building up inflationary risk in the economy, they have seemingly got it right. They've struck that right balance. So my central case is for a short, sharp burst in price inflation in the first half of 2021 as a result of money being printed, as a result of consumers going out and having a bit of a splurge when they're able to, and also as a result of the Brexit trade deal issue and a short-term spike in import prices. I don't see that leading to a period of hyperinflation in 2021. I don't think we're talking about double digit or triple or quadruple digit inflation for any sort of period of time in the near future or even in the longer term. But inflation is certainly a risk that I think we have to watch out for. It's a risk to our wealth. And I'll come on in a second to talk about some ways to protect your wealth from rising price inflation. And then looking ahead to the medium to longer term, I don't agree with economists who say that price inflation is dead. I think we will start to see inflation rise again in that medium to long term, partially for structural reasons. And here in the UK and in many developed economies, we have an aging population. So one of the challenges is having sufficient capacity in the workforce to enable us to continue producing goods and services, to maintain supply and therefore maintain prices. So that structural issue of an aging population could feed through into higher price inflation. However, it's likely to be offset to some extent by rising levels of automation, but also artificial intelligence, creating efficiency gains. So actually an absence of younger workers won't be so much of a problem, probably in the future, as it would have been had it happened in the past. So what steps can you take to protect your wealth if you are fearful about rising prices? Now, a good place to start is by looking at the component parts of your investment and pension portfolios. Look at how that money is invested. If we look at the various asset classes, investment asset classes, and we look particularly at fixed income securities or bonds, that's a really good place to start. Now, over recent years at Informed Choice, we've been gradually moving away from some types of bonds because of this future risk of rising price inflation. Now, that includes UK government debt or gilts. It also includes UK investment grade bonds, corporate bonds, and we've been gradually moving slightly away from those and into higher yielding debt, but also international and emerging market debts, which should weather any rising price inflation slightly better. You can also hold equities within your investment portfolios. When prices rise, the profits made by companies tend to rise too, and that then tends to lead to rising dividends. And then over time, you expect the capital value of company shares, equities, to rise over and above any rise in price inflation. So equities are actually a very good hedge against rising prices. And then another core component of many investment portfolios is commercial property. Again, an asset class which tends to perform very well during periods of rising prices, so a good hedge against price inflation. There are some alternative investments you can consider as well if you're worried about rising prices. Often people will talk about commodities and natural resources as a good hedge against inflation. Now, you have to be a little bit careful here because it's not always the case that rising prices feed through into higher commodity prices. It has happened in the past, but there are also periods of time when commodity prices have not kept pace with rising prices. Now, gold bugs will tell you that gold is the ultimate hedge against inflation. I don't agree with them. I think that the risks of holding gold outweigh any of the benefits. Gold is a non-income producing asset, and whilst over very, very long periods of time, we're talking hundreds of years, tends to be a reasonable inflation hedge, that is not the sort of timescale that a typical investor is interested in. So watch out for gold. Be wary of people who tell you when prices rise that gold is the place to be. One aspect of your portfolio that is likely to get hammered by rising prices is cash, so money in a bank or building society savings account, and that is because the buying power of cash will not keep pace with rising prices and it will erode its buying power. So look at how much you need for your core operating expenses as a household, look at how much of a buffer you need as a cash emergency fund, and then invest the balance. Don't keep too much in cash, because even in quite a short-term scenario of higher prices, the buying power of your cash can be quite quickly eroded. It will certainly be eroded over the much longer term. And away from your investment portfolio, take a look at your household budget, take a look at what you're spending money on, look for opportunities to slash your spending, because again, if prices start rising and you can spend less on areas which are not that important to you, that is an incredibly powerful way to guard against higher price inflation. In summary, I don't think that we're going to see hyperinflation here in the UK. I don't think we're going to be measuring inflation here in terms of sextillions or with multiple zeros after the number. But I do understand some of the concerns about printing money, about public debt, about this short-term impacts of Brexit trade disruption, and about this pent-up consumer demand and people going out and having a bit of a splurge on the high street on their holidays once they've had the vaccine, once they're able to. So I understand all of those risk factors. But even with all of that, I don't believe we're going to turn into another Zimbabwe here in the UK. However, if in 10 years' time I'm sitting here with a £10 billion note behind me and not 10 billion Zimbabwean dollars, then clearly I've got it wrong, and I think that's probably pretty bad news for all of us. I hope that's not the case. Would you like to receive a short weekly email from me straight to your inbox every week? It's called Martin's Midweek Money and it's completely free. Go along to sendfox.com/Bamford to sign up. It's full of personal finance news and tips and also some behind the scenes exclusive content from me. So sendfox.com/Bamford to sign up for my Midweek Money newsletter. Thank you for watching this video. Until next time, I'm Martin Bamford, and when it comes to your money, the more you know, the faster it can grow.